Hi, I'm Roger McClure. I'm an attorney who's been practicing law for over 30 years in wealth and business planning. I'm here to invite you to view some videos by Bill Conway, my colleague, about how to preserve, enhance, and protect your wealth. Bill is a nationally respected attorney who specializes in wealth and tax planning. If you have any comments about these videos, we'd love to hear from you. So contact us through our website.
That has to do, we're talking about one topic right now that has to do with how do you get basis. How do you get basis? We talked at the early set, or the early time, where we are going to discuss with clients not changing the plan they have now, but adding something. So I'm still not very much believing in the classic A/B trust planning. I'm still having a marital trust and a family trust, especially because I've got Virginia clients, or Maryland clients and Virginia clients, but I want to have these assets asset protected, and I want to have them inside of the trust. But what about when that client dies? If I have highly appreciated assets in there, I want to be able to get basis in. And what we've been doing is we've been putting in an option that either a trust advisor or a trust protector or a special independent trustee will have the power to grant to the beneficiary of that trust, of the trust that goes to the surviving spouse, by example, and a family trust that's otherwise be outside of the estate, if that spouse does not have a taxable trust, taxable estate, to grant to that spouse a limited, what I call limited general power of appointment, grant a restricted general power of appointment to grant to the creditors of his or her estate the value of in the assets in that trust up to a certain amount, which would then cause those assets to be included in their estate, get a step-up basis on those assets. Okay? In a world where you need flexibility, you need to give that power to somebody to grant a general power of appointment over those properties. And you can grant a general power of appointment to give it just to the creditors of the estate, just to creditors. And if it's just to creditors, it will never be executed, or unlikely to be executed, number one. And number two, it's just the existence of the power causes it to be inside the estate. Right? So now if we had an Alaska Community Property Trust, by example, where there's a surviving spouse, right, and there is the assets that got a step up when the first spouse passed, right, all those assets got a step up, and then the survivor has his or her assets outside of the assets that were left inside of the family or the B trust or the bypass trust for that survivor. You can give somebody the power to grant to that spouse a power to get a step up. And by the way, that doesn't have to be limited just to the spouse. That can go to every generation. So you have a protector at every generation, or a special independent trustee at every generation to give that. So always provide basis. If you always provide basis, you're never going to have a capital gains advancement. Right? But it can still stay in the trust. Right? Good enough? Okay. What we're going to talk about today is a series of strategies, a series of ideas that I think most of us may already know, and putting them together in a way that will be important and perhaps better stressed in the year 2013 and beyond because of the new tax laws. And so what I want to do is start with a review of what the tax laws are and how they affect you. And I'm going to principally talk about income taxes, because I think that there's so much more now about income taxes we have to do than we've ever had to do before. The battleground has shifted. There are a whole series of new rules, and those new rules have to do with the amount of taxes, whether they're assessed, they're paid, and who is going to fall prey to them. And then in the second portion, we're going to talk about what I call recipes. And I mentioned earlier that I have a kind of a cookbook that I'm going to give everybody with recipes in them as to how you can put together strategies and ideas to be effective for clients. Most of those recipes are going to require the cooperation of estate planning attorneys, with CPAs, with financial advisors, with insurance agents, and the like. They're all a compilation of how we work together for the best and the most substantial results for clients. So that's me. Okay, what changed in 2013? Things that we already know, or things that we can quickly recall. We have estate tax exemption, generation skipping tax exemption, moving up to $5,250,000, and they're both inflation adjusted. Our annual exemption is now moved up to $14,000. This annual exemption is becoming a lot less relevant. People are still using all sorts of crummy powers and things to access that. I would say that that's kind of now passé. I would be certainly using annual exemption, or excuse me, lifetime exemption for the clients that you can use it for, simply because it's easier to plan when we get to generation skipping and the like. We worry about permanence. We talked about we now have a permanent bill, but right out is no sooner than the ink was dry did the Obama administration put through what they call the Green Book, and the Green Book was in April, the bill was signed in January, and we now have a proposal to reduce the exemptions to $350,000. Also, other things that have changed. Some states continue to decouple. There are additional tax structures in some states. As we are aware, the last conversation I had before I came over here was with a colleague in California. We're working on something together, and all of a sudden we're talking about the income tax structures that he has in California for clients he has in California. And now California just voted themselves a 13.5% income tax bracket as the highest marginal bracket. Maryland did effectively the same thing. Maryland's highest tax bracket is, I think, 9.5 at this stage. So we're talking about some huge changes. We also have changes in income tax on dividends. We're going to talk a lot about step-up and basis today, because step-up and basis now becomes an important function, because now in a world where I'm less concerned for many clients about estate taxes than I have heretofore been concerned, I'm going to try and do all the things I can to get a step-up in basis at either the first and or the second death in estate planning. We're going to talk about that. Of course, we have changes in Obamacare that's in the headlines virtually every day about the ways that it is or isn't working. I saw something in the Wall Street Journal today talking about how the state exchanges look like they're going to be delayed. I know people all of a sudden beginning to panic a little bit. The costs are beginning to come in on certain states as to what those expenses are. Many people have begun to focus more about Medicaid. I'm having more and more wealthy or semi-wealthy people talking to me about Medicaid, given the fact that they've changed their cost structure and taxes and the like. And of course, the changes in certain matters of healthcare decision making. So where are we seeing income tax wise? Well, income tax, we have, of course, these brackets that we've had for quite a while. The 28% tax bracket being kind of the benchmark. And then we have the 33 and 35% rates were made permanent except up to certain thresholds. And now these thresholds for single taxpayers are $400,000, and for married filing jointly is $450,000. Now, as we're going to be talking about in a few moments, all these are functional exercises in what is known as AGI. For those people that do a lot of income tax returns or income tax planning, this is quite familiar, but AGI, of course, is the last line on the first page of a 1040. And everything is driven through AGI. And as everything is driven through AGI, it's going to functionally deal with all those issues of deductions or lack of deductions, of phase-outs. It's going to be dealing with things that we're kind of familiar with, which has to do with our issues related to AMT. But as we're going to learn in a few moments, it also has to do with beginning of phasing out of deductions that we always used to get. And we're going to talk about that. That's an additional functional exercise, additional functional increase in the amount of of taxes people pay. So amounts above these thresholds of these single and married filing jointly are now at this 39.6% tax bracket. 39.6%. And then, as the phrase goes, but wait, there's more. We now have capital gains rates. So we have capital gains rates, which were at 15% for those same threshold amounts. But once we get above those $400,000 for single individuals and $450,000 for married people, they jump to 20%. Now, let me point this out quickly. This is a function of AGI, adjusted gross income. And adjusted gross income is inclusive of whatever capital gain I would be paying. So if you had someone that in their lifetime, a farmer, a business person, never earned more than $120,000, $150,000 as an individual or as a couple, in the year in which they sell their business, in the year in which they sell the farm, in the year in which they do anything, they are automatically the wealthy. And when they are the wealthy, they're now at this higher tax bracket. They're now at this 20% rate. But wait, there's more. We have now also the additional 3.8% Medicaid surcharge. This has been on the books ever since the law was passed in 2011. but the year in which it kicks in is this year. So now we have a 20% amount of capital gains or dividend, anybody who's above AGI, and this 3% Medicare surcharge. So we have this applying to AGI over 250 and single for 200,000. So now we have a very large tax increase. And I did a workshop similar to this not that long ago, and I asked somebody, well, what's the difference between the 15% capital gains rate that we always used to pay, we have been paying it for roughly 10 years, and now the 20% capital gains rate enhanced by this 3.8, which I point out is nearly 24%. What's the difference between 15% and the now 23.8%? And someone said is 8.8%, which of course is what the government wants you to believe. But in fact, what it is, it's a 60% increase. This is a massive increase, and we haven't yet gotten to state income tax rate. So now again, in the state of Maryland, you're now going to be in a 9.5% rate. So now I have a capital gains rate above the threshold amount here of AGI of $250,000 per married couple. I'm also going to have that coming up to this nearly 24% rate. Maryland, we're going to add this, let's call it 9% to make things simple. We're now at about a 33% tax rate. 1/3 of all gain above that threshold is going to go down the road. And I dare say that we're going to see a lot fewer transactions of sale. You know, this classic where people begin to react rationally. They look at how much tax there's going to be, and they decide not to pay it. So there's going to be some strategies we can talk about, inclusive of installment sales and some other things we kind of have to pull off the shelf and use for a period of time that maybe we haven't heretofore or have not long time since used, because the tax rate at 15% was much lower. But now with states increasing their taxes in some states, and with the federal government increasing the tax at the level that the state has, we now have this absolutely massive amount of increase. So that's our capital gains rate. The other thing we have is we're going to have a limitation on itemized deductions. This is the family with 16 children or 5 children or 2 children, whatever it may be. Personal exemptions, personal deductions, those are no longer going to be available. Once again, you have a beginning to phase those out at the same level for single taxpayers and married for them jointly at $300,000. And we also have, well, I mentioned personal exemption. This is for itemized deductions, phased out at a rate of 3% above threshold level to a maximum of 8%. So all of the mortgage interest deduction we've been used to getting, that state income tax deduction that Maryland, 9% and more, the state income, the deduction for the state of California, here in Virginia, the 5.75%, those begin to be phased out. All of the interest, home mortgage interest deduction. Of course, we already have phase outs on, or limitations on medical deductions. That's now up to 10% of AGI from 7% of AGI formerly. And so all those things so more taxes are what everybody's going to be paying. And some of these taxes are kind of sneaky. It's going to be a great surprise to people when they're going to be paying these new taxes. So we already have phase out for investment interest, medical casualty deductions, and gambling losses. Personal exemption, same basic strategy. All those, as I mentioned, the number of children one to have and the aspects associated with that. That is the issues related to our personal exemptions. Those no longer become available. And it is a big thing when we begin to structure. So I think that when people are talking about saving money, it's going to cause a lot of people who begin to do things normally for clients and planning, you're going to have to run some, even more than before, a series of dummy tax returns just to see exactly how that kicks in. It's going to be very important to deal with that. Okay. So again, here's where the personal and phase-out range. Married for the jointly phase-outs beginning at $300,000, and phase-out ends at $422,000, meaning that between this number and that number, all of a sudden, those deductions have gone away. It's a pretty quick number in terms of phasing out. So once you're a client above $422,000 of income for married couple, and remember that, ladies and gentlemen, this is AGI. This may only be in the 1 year that somebody actually sold the farm, sold the business, whatever, sold those securities, made a big gain, maybe had a tender offer for something that was kind of out of their control. All of a sudden, they're going to find that these deductions no longer work the way they did. They're going to say, oh, it's not a problem because I'll prepay my state income tax as I always had. That's not going to work. I'm going to begin to take deductions for other items and phase out, make larger charitable deductions. Again, these are going to be phased out. The implications of these are far more than what we're going to be able to discuss today, but it's important that we have these and have them structured and understand how and where they work out. Now, for those people that have AGI who aren't at a stage where we're dealing with interest income or capital gains income, which heretofore have been not taxed, they basically escaped this tax. This is the Medicare payroll surcharge. So people who have an income of $1 million have always had this surcharge over and above their income tax capped Social Security contributions. But now we have this, and it's now at $250 for joint filers and $200,000 for single filers, and for now the investment income over and above that number, we have these coming in. There are also going to be special rules related to people who are under mandatory distributions, such as required minimum distributions for IRAs, 401k plans, thrift plans, and the like. So all those things taken as a whole, again, mean that we're going to have a much higher tax payments we had before. This is a repeat of the slide. We have a new Medicaid surcharge, and all investment income is added for AGI in excess of $200,000 or $250 for people filing jointly. And so here we have the charts of how these things come in, the 9% increase in the Medicare tax, when the 3.8 is applied, the phase out of itemized deductions and exemption, the 20% capital gains rate, and also for dividend, and now the new income tax bracket. What isn't here, of course, is the state income tax rates that will kick in, and this 3.8 needs to be put on top of this. This slide is actually a little bit inaccurate from that perspective. But that's where these things will kick in. All right? Reset.
That's the end, and that's
Yes, yes.
Let me ask a question.
Yes, please.
Is there a limitation on charitable deduction?
It's phased out. The limitations haven't changed. I mean, there's always a limitation. 50% of AGI for cash, 30% of AGI for appreciated assets, 15% if I'm giving, or 20% if I'm giving to a private foundation. I mean, there's a whole series of those rules in terms of how much deduction you get for the contribution you put in. Those are normally going to be carried forward. So if somebody had an income of $1 million and made a contribution of $1 million, then they'd only, and in cash, they'd only be able to deduct $500,000 from their taxes. The other portion of $500,000 will be carried forward, but there is a phase out of the deduction, right? Once they're above the 300, what number they're at, if they're at $350,000 to 422.
Yeah, I didn't see it listed as one of the deductions.
Just a minute. It's a standard deduction. It's all deduction. All itemized deductions. There are no excuses.
The wealthy are the ones that contribute to charity and are very active in these non-governmental aid programs. That would really hurt, I would think, a lot of the large charities.
It can. It can. The places people are going to get really hurt is going to be in places where the deductions that they would, like by example, in the state of Texas, there is no state income tax, right? So technically, your deductions get phased out. If you have a large amount of them, you're going to phase out things like your state income tax, by example. Then the charitable deduction might be still attractive because of the way the phase out works. But it's going to be more attractive in states such as New York, California, and Maryland, where the state income taxes are much higher.
So Bill, the bottom line is, maybe just restate the obvious for everyone. That is, for most people, most of your clients, they won't have an estate tax problem, but they're going to have a much larger income tax problem. And so as a result, we have to focus on how to save income taxes through the estate planning and other planning processes.
And if I could, back on Roger's point, the Obama budget would not call for the $3.5 million estate exemption until 2018. There would be no inflation adjustment, and it would call for a reversion back to the $1 million gift exemption. So folks would not have an estate tax issue even under the new budget, if it's ever passed, until 2018.
Right, and what I didn't go through were the, quote, endangered species, which are the things related to I think I have a slide coming up on that, but basically related to length of grats, period of times, generation skipping being limited to, as you say, $1 million, getting rid of basically the opportunity to give for multi-generational trust or something what we call dynasty or multi-generational trust. All of that is now going to be truncated.
And thank you for picking on Maryland. We love to tax people up there.
It is baffling. I mean, I must say. I mean, you've got certain states going one way and the other states going the other. But that's how life is, I judge.
So this is the next section. What?
Bridget, I'm sorry, I crossed you up there before. I realized I cut off a little.
Yeah.
Okay. All right, so
now we're starting the next segment.
yeah, we'll just do this next segment. So the question now is what to do for the clients where arguably the estate planning or estate tax issue is off the table. This is some general ideas, obviously. We still have to deal with the desired distribution. We still have to deal with probate avoidance, those issues related to that. Privacy. We have to deal with who will they be naming as decision makers. Tax avoidance in general. We're going to talk largely about income taxes here in a little while. And leveraging exemptions, and also means that maybe dealing with some interfamily structures. Asset protection, of course, is going to be key. As we learn more about who pries and whose business and how things are being done and who can get at people's assets, it strikes me that this is going to be a very sensitive spot for an awful lot of people. They're going to want to learn more about what they can do to protect their assets, both against prying eyes as well as other people getting their assets either from them or from the people to whom they wish to give it to. Generation skipping is still very much a strategy. We're going to talk about something related to that, retaining financial benefits and control for family members. We mentioned a moment ago that we're going to be looking a lot at income taxes. So there still are opportunities for charitable trust planning. I think principally you can look right now at charitable lead trusts, especially now in a very low interest rate environment, people who are charitably inclined and want to receive resources back and keep those assets protected. There are good opportunities there. Charter-minded trusts maybe a little less so because the interest rate environment is still low enough that they're not getting maybe the deduction they want to get. But that will change here as interest rates begin to pop up. We're going to talk about partially taxed single premium annuities and so-called SPIAs here in a little while. Talk about why we might be using them in an income tax world. When I'm escaping the taxation on certain things, what or more can I do to escape taxes we have to do with this? And we'll also talk about community property trusts under Alaska law. And those community property trusts under Alaska law, I think, is kind of a huge opportunity that are not being at all used by people who can use it. We'll talk about how and when we can use those strategies. So it's a way to provide a step-up in basis at the first spousal death for somebody who is, in the case of a married couple. This is just I didn't know that slide was there. That should be later in the program. What to do now, for the client that has less than $5.25 million per person, or perhaps if we double this for a married couple. Income shifting through family entities. Big deal. It's always been a big deal, but it's a bigger deal now because now all of a sudden income taxes have gone up to such a level. And remember this whole AGI? There's going to be years in which we want to be able to shift income, if we can, to and among family members. The people have the right situation, the right amount of income, the right everything, the right positioning. But if and when they decide to do that, this is going to be a big opportunity. I mentioned a while ago installment sales of real estate and business assets or entities. I was stopped recently by an acquaintance who began talking about selling a property that he's owned for a long period of time in the District of Columbia. He talked about how he bought the property for a fairly low price, maybe $50,000 or $75,000 range. It's now worth maybe $500,000 more than that, and he has depreciated it down to virtually nothing. And the question I was asking, he's a man in his late mid-60s, he has no children, he just was tired of managing, just didn't want to have it. And he started talking about what he could do, and I said, well, what do you plan on doing with the money? He said, I don't know, I guess invest it. put it in a certificate of deposit, put it in a, wherever, put it in an account. I mean, conservatively, he's very concerned about losing money. Well, if this is a property he's owned all those years, and he's happened to receive a sufficient amount of down payment, he can, of course, be the bank for that particular purchaser. And if that's the case, instead of getting, remember, he's single, his AGI would certainly be above the threshold amounts. He lives in the District of Columbia. That's a 9% state-to-state tax environment. He's going to be at the highest level for capital gains purposes, plus we're into the 3.8% surcharge. He's at a 33% tax. So he'd be giving away $200,000 almost in taxes and not earning income on the $200,000, whereas if he received some money by a down payment, then he could be the bank for, let's say, $500,000 at an interest rate that is commensurate with what banks are charging, perhaps 3.5%, 4%, perhaps, maybe a little more, maybe less for interest, and he's getting on all the money. Plus, he still has the money coming to him. Now, certainly, as there becomes principal paydowns, he is going to have to then suffer his capital gains, but it begins to then be spread out. He's never going to be in a year where his AGI is now going to be in these upper ranges. And the consequence of that is this is a really important place. And so we have to get to people sooner than later. It's not the people that call us on the phone and say, what do I do now that I've sold the beachfront property? You know, it's like, okay. It's a little late to be talking about that at this stage. But all of these structures and strategies do. I also think it's giving incredibly new life to any life insurance policy that has cash value. That in the past, these have been viewed as maybe more conservative investments. People have wanted to do more and better things. You have to begin to now look at the after-tax returns. If I can access cash from a life insurance policy and be able to get that cash out for at no income at all, I can borrow the money back. And we'll talk about some structures how to do that in a little while. All of a sudden, that begins to become a far more interesting prospect than even a very high rate of return at which my tax marginal rate can be as high. If it's ordinary income, it'd be like these people putting money in hedge funds. You know, all of a sudden I'm in a marginal income tax rate of 39.6%. Then I get my state rate kicked in. All of a sudden I'm at almost a 50% total rate in Maryland, in D.C. In California is even more than that. Even in Virginia, we're at a really high tax rate on the margin. So where I have no tax assessed and I can access resources. So that's a place you do that. And then, how would I do this and still protect it? I can do that within an accessible grantor retirement trust. Meaning I can put these assets into a trust where I can either access those through the utility of a trustee. I can do that in a number of different ways, or I can have it set up where my spouse, if I'm married, can also be the person that can access these cash values. We'll talk about these strategies in a little while. Remove and reduce IRAs, 401k assets from the estate. People often startle when I say, this is your worst asset. This is the one you want the least of. Certainly if I was getting a choice, if I had 2 children and one was going to inherit my IRA and one was going to get cash, the one that raised their hand the fastest and said, please give me the cash, is the one that's getting the better asset. I mean, all these assets are like ticking time bombs. I mean, I've got them, and maybe I can stretch the income out over a period of time. For some assets I can't. Some strategies I can't do that. And all of a sudden, all those assets that I've been deferring the income on for all those years, all of a sudden are visited on my beneficiary. It's a terrible thing to own unless I don't have a choice. It's wonderful to retire on. That sounds great. But if I'm going to pass it on, move it on, or give it on to somebody else, I want to be able to consider to do something else with that. And I can do that, and we're going to talk about strategies to do this. We're going to talk about in circumstances where I'm afraid I can't do that, or I can't make those changes. We're going to talk about setting up special types of trusts for retirement assets in IRA strategy. And we're going to also talk about potentially, or you would certainly be studying, we're not going to really touch on this today, IRA conversions. These are increased depth of client service, elder law issues, legacy planning, expanded conversation with clients about how they can pass financial and non-financial wealth on to others. I did mention a moment ago the endangered species. The Obama plans to make certain strategies endangered. Grantor trusts are on the endangered species. You might be able to do something with ones that are there. They won't ban those, that new contributions to them, new sales to them, new gifts to them, all of a sudden is a problem. Discounts are still wise on business interests for transfers of minority interests, but those are things that are definitely on the endangered species here. I mentioned that grats are on the attack list, 10-year minimum grats. We've been hearing about this for a long time, and where we have a 90-year limit on GST planning and dynasty trusts today are still possible. So making gifts early and often, for those that can, still makes sense. This is a biggie. Money loan for property sold for installment notes within, I just happen to have the 3 to 9 year term. It could be clearly the longer term or the shorter term. But the 3 to 9 year term, I have an old date in here, but these aren't that much different right now. You can loan interfamily for about 1%, about right now maybe 1.4%, something like that, interfamily loans. Really important way to make monies to, and of course, so it's an ideal time for interfamily loans and gifts. We have also business tax extensions and opportunities. We have the reduction in S corporation. If you have clients out there that have C corporations, it's now time to convert these to S, right? If and when they can. Before you had a 10-year time frame you had to kind of get through. That has now been reduced to 5 years. And 5 years, as time goes by, all of a sudden someone looks up 4.5 years from now and says, gee, I could have done that 5 years ago. Well, I mean, these times go by, and having double taxation makes no sense, especially no sense, in a current tax environment. And we still have anti-preferences rules still available. So, yeah, any questions?
Now, you had talked about that last week, community process.
Oh, that's a drain.
West?
Yes, at the end. Okay. What do we do to address change? We need to have both flexibility, but also in a world where there's absolutely much uncertainty. So what do? We're going to put now into our documents things that people are calling trust protectors. Now in our office we use the word trust advisor, but they're really the same structure. In the wealth counsel system we use it, it allows you to use advisor protector as the case may be. It's interchangeable, but we do that. What other things? Marital deduction formulas. Golly Moses. We got a lot of states with different issues. We have Maryland has a series of issues. They have a state estate tax. D.C. has a state or district of Columbia estate tax, both of which kick in at $1 million. And I have to retain enough flexibility to deal with that with my marital deduction to get the best result I can possibly get. So I have to think about it. I have to kind of rethink those things. I also have to think about using ways where trusts that are already in place. This answers the question that came up earlier. Trusts that are in place where people have already died. How do I now deal with those trusts? The trust where the surviving spouse, husband or wife, the survivor, what do they have? Especially in a world where income taxes are important. Especially when the underlying assets within those trusts now have increased in value, but it has increased so much that they're going to include that in their estate. Right? There's ways to deal with that. But those are things that have to be adjusted. Every single one of those has to be looked at. Disclaimers, the revocable, irrevocable trust. Now we can do so many things with irrevocable trust that they're fundamentally revocable. I mean, we can have changes built in by both using trust protectors as well as independent trustees, as well as using decanting statutes in a lot of states to really cause these trusts to be substantially changed and restated to kind of fix them up where they weren't they were solving yesteryear's problem. You know, this is the idea that the generals constantly, always fight the last war. So we want to be able to be on the forefront of fighting the new war. And the other one that we want to think about, because I mentioned earlier asset protection, is I can now have a trust that I can create for myself and have asset protection. I can cause that to be either a gift which is complete, which means it's out of my estate, or it can be incomplete, which means it's still within my estate, but either way, I'm asset protected. But this no longer is kind of out there so iffy, where you're dealing with Alaska and Delaware kind of being the only ones that are doing it. Now you have 14 states, including the great Commonwealth of Virginia, has now adopted the opportunity where people can put their trust in. Freeze transactions, aftercare planning, again, ways that we can address change. What hasn't changed? Avoiding probate, protection of a surviving spouse, philanthropic objections, planning for heirs, with youth, responsibility, divorce protection, protecting against the classic affluenza issue of giving money to people too early. When I do workshops, I'm always stunned by the number of attorneys that raise their hand when I say, how many here are allowing the resources to go to family members at, say, tranches, a third at 30, a third at 35, a third at 40. We never do that in office. We always have dynasty or multi-generational trust, and I'm constantly surprised where that is happening. they're not doing it for their own spouse, but they're doing it for their kids. It seems kind of nuts. You know, I mean, you don't know what's going to happen with your kids' lives. You kind of have a confidence if you marry someone for 20 or 30 years, what's going to happen. But divorces happen, lawsuits happen, and they happen after people become 40 years of age. So, business planning. We at Wealth Counsel have started something called Business Counsel, which enables you to kind of more effectively write documents, or lawyers to effectively write documents. But the whole concept of what we can do with entrance, growth, maintenance, mergers, acquisitions, and exit strategies now become much more important for people doing the planning side of that, the merger, buy, sell, the insurance things. Those are all critical things as well. Elder care planning, special needs planning, and asset protection. What also isn't changing? The need for life insurance. As I mentioned earlier, it's probably gone up, right, because of the income tax considerations. But certainly all of these issues, liquidity, income replacement, paying state death taxes, there are 21 states that still have state estate tax, right, inclusive of D.C. and in Maryland. Wealthy placement for charitable buy, sell, capital gains, liquidity, and for supplemental tax-free retirement. This is the one I mentioned earlier. All right, I'm going to move over this. In financial services, we're all aware that certain products and services have changed. There's now becoming a much greater division between what is advisory business and commission business. This again is more what time is it strategy. Equity index products, people love them or hate them, but either way they're there. And the idea that you can use them or look at them is something you can make your own judgment on. But don't knock them out. There are people who wanted, the reason why they're such big sellers is because people are looking for certain kinds of guarantees. And guarantees in a world where people saw a third of their securities value or more drop between 2000 and 2003, and that very same thing happened again beginning in late 2007, 2008, 2009, and beyond. You know, there's a certain world of that, you know, once born, twice burned. But in a world where maybe some of these people have already been twice burned, they want to look for certain levels of guarantees. Private annuities, captive insurance companies, opportunities for business people to use other strategies. What also isn't changing for financial services, need for estate planning, client-centric planning, and to be used certainly as a financial complement to legal strategies, and we'll be talking about that. So the strategies here are what we call the post-aftermath, what we're calling thriving strategies. The issue is reduce or eliminate current and future income taxes, asset protection, and provide a means for future estate and generation skipping taxes. So we have new solutions for the new rules, recipes for the new income tax solution using old and new ingredients. So I have for you the cookbook. The idea here of recipes is this. In this very community, there's a restaurant called the Clean Family Restaurant. People come here and know that. And for a period of time, there's a kind of fancy restaurant, kind of a shopping center way across Chambridge Road that is what's called Bistro Vin Bon. And you know something I noticed? I noticed that the delivery truck goes to both restaurants. And since the delivery truck goes to both restaurants, they both get bread and milk and eggs and sugar and fish and milk and all those products. They all go to the same places. Right? It's how they put those things together that's the big key, right? It's how they do it that's different. The recipes at the kind of the one with the finer dining experience is how they put it together, different things, different tastes, different things, maybe different skills, maybe a little more time, but whatever it is, it's worth more. And what we want to do is think about putting together recipes that are now more tasty and more useful and more applicable to clients under their current set of circumstances. So let's look at our legal ingredients. We still have revocable trust, we have irrevocable trust in every flavor you can imagine. Insurance trust, dry trust, trust for holding, standalone trust for holding IRA assets after someone dies, intentional grantor trust for asset protection, Q-tip trust or the inter vivos Q-tip trust or ones that are post-mortem, family partnerships and LLCs, and retirement plans. Those are kind of the ingredients there. And some financial recipes we have life insurance, which of course have single life or survivorship or second to die type policies. We have design options. What the question came up earlier. I mean, we have low premium and high death benefit, or high premium and low death benefit, meaning high cash value. Do I have single premium, or there are places even with modified endowment contracts, right? When and how would those come in place? Again, a time-telling thing. This isn't really how the watch is made, but we're going to talk about this. So life insurance come again in their own flavors, cash value. We have universal life, which is guaranteed or not guaranteed. Variable universal life, also non-guaranteed, sometimes guaranteed. Equity index can be guaranteed or not. We have whole life policies, standard cash value policies, and of course term policies. We have annuities. Here again, I think so many people really don't have a real conception of how good or bad annuities can be. It's really the right tool for the right job. I've heard people say, you should never have an annuity inside of an IRA, whereas I've seen a lot of opportunities where annuities inside of IRAs made a lot of sense. Deferred annuities. The ones we should have inside of IRAs are probably single premium annuities. We'll talk about that in a minute. But the problem with the deferred annuities, they have surprise income tax results. You know, all the money coming out of an IRA, out of a deferred annuity has to be paid out within 5 years. Has to be paid out within 5 years, unless it's annuitized over the life of the beneficiary, which most people don't necessarily wish. But it's got to come out within 5 years, and it has to come out life only. So if I delayed the full 5 years, or I took 1/5 from each of the 5 years, I would still be paying the big income tax hit every year until I got through all of that growth. It is a terrible asset to die owning, because giving it away to somebody is giving away one of those ticking time bombs. It's a terrible asset to pass on. It may be a terrific asset to save money or to invest money for certain guarantees, but it's the right tool for the right job. Immediate annuities, single premiums, and we have different flavors of immediate annuities: life only, and the longer term of life, or life, and we have or multiple life. So this is strategy number one. Annuitize an IRA. Remember I said earlier, your IRA is your worst asset to give away, because giving it away to somebody is passing on that tax time bomb. If somebody saved $1 million in an IRA, someone's going to get $1 million with the tax liability attached to it. You can stretch it out, you can do all sorts of things with it, but it's only going to be worth what it is minus the income tax in the hands of the recipient. And I can use the perhaps lower tax bracket, or at least not a higher tax bracket, for the current IRA annuity owner if he or she wishes to make a legacy distribution to either a spouse, or a child, or a grandchild. And I can do that by buying within the annuity a single premium annuity. So I have an immediate annuity. And I'm going to use those annuity purchases to pay an income tax due. I'm going to then, because I'm going to make a distribution, and then I'm going to use the balance, or a portion of the balance, to buy a life insurance policy inside of an IRA, inside of a life insurance trust, to provide asset protection, creditor protection, divorce protection, estate tax free, and I can possibly increase my standard of living. So here's the example. I have an IRA. I've used it to purchase an annuity inside of the IRA. That is now going to make a distribution of that income to the owner of that IRA, who is going to make a contribution to the IRA. And then, of course, this ultimately, at that person's passing, the money is going to move on to heirs. Income tax-free, estate tax-free, creditor protected, divorce protected, more than I can do with an IRA, or certainly better than I can do with an IRA. So the advantage is I can get like a pension-like performance. We'll see an example of this in a minute. I can get a guaranteed income. A lot of people, what they want is guaranteed income. I've seen studies where people have had Joe and Jack who live next door to each other, and Jack has an annual income coming in for a pension, where that pension is going to end when he does. Let's make it simple. He's a single guy. And his friend Jack has a lot of money in an IRA, but he's jealous of his neighbor because his neighbor has a guarantee. Well, the one with the lot of money, either in cash or in the form of an IRA, can convert that cash into a pension. He can become like his neighbor. Now, the net result of that is that there's often not going to be money remaining. He can't get it for cash, but his neighbor couldn't get it for cash either. But now, for somebody who doesn't actually, quote, need the money, and I'm trying to provide a benefit for my spouse that's tax-free, I'm trying to provide a benefit for my child that's tax-free. And in this community where you have a lot of people who are on federal pensions, where the pension is going to be down by 55%, they don't need the money in the thrift plan of the IRA right now, but their spouse will need it later. But yet when the spouse takes it, it's going to be income tax. So we can convert that. We can eliminate the income tax to the heirs on these inherited assets. It eliminates all estate tax, and it can also eliminate generation skipping tax that are coupled within an IRA. and I can get a guaranteed death benefit beyond the age of 100. So I can couple my guarantee of death benefit with my guaranteed lifetime income. It, of course, depends upon insurability, and of course, the bottom line here is the IRA or some of it is committed for income tax generation. I've turned it into a pension. So here's an example. We have an existing plan of death, and this is the income tax drag. It could be that tax, a little more, a little higher. Remember, this is going to be on top of whether income the beneficiary has, right? Required annual minimum distribution. So it's always going to be reduced by some level of tax. So $1 million becomes $700,000, it becomes $600,000. In an estate tax environment, where I have an IRA where there's an estate tax of 40%, then I take out the income tax. Now only $300,000 goes to beneficiaries. I mentioned that client earlier where there's only 12% or so going to his beneficiaries because of the state estate tax and the state income tax. Whereas if I take the IRA annuitized plan, I guarantee $1 million within the ILIT going to family members in both examples. So not $700,000 but $1 million, not $300,000 but $1 million, and you cannot run these taxably. Let me show you the example. This is a real example. We did this one not that long ago. IRA owner, age 70, healthy male, non-smoker. His IRA value was $1 million. His tax rate was 30%. His annual annuity payment coming from $1 million IRA, reported as part of it, is $75,000 a year. $75,000 of cash flow coming to him. The income tax, 30%, is $22,000. The insurance premium was approximately $25,000, leaving $27,000 of after-tax income after having replaced that IRA. Right? So he still has spendable money after tax, approaching 3%, which is more than he's getting on the CDs or whatever he has invested in now. And it's giving him this better overall result for family. A variation is to annuitize the cash or bonds. Right? A lot of people have money in CDs and cash, are afraid to move it out. Those are the people that have been whacked twice on investment in securities. Maybe they never invest in securities. Maybe they never will invest in securities. But all of a sudden, they can use their CD or bond money, any kind of guaranteed assets, to purchase an annuity, and creates a self-funded, tax-favored pension-type return, pension-type income. And we can use the annuity income, once again, to pay the income tax due. And the income tax is much reduced because there's this thing called an exclusion. If the money coming out is my money, I already paid taxes on it, and at least through my life expectancy, I don't have to pay an income tax on very much of that coming out. The insurance premiums for enhanced wealth transfers, we're going to pay that, and I've substantially increased the cash value for living. And of course, we're going to put that inside of a life insurance trust. So once again, cash buying annuity produces income for the owner, putting a contribution now into an irrevocable life insurance trust, which is now providing a benefit for the beneficiaries or earner. And here is a real example. This happened, I mentioned my 80-year-old. This is basically the numbers that he was dealing with. He was a healthy male, $1 million, tax rate of 30%. His annual annuity payment, and interest rates right now are fairly low, this will be higher as things went on, was $113,000. That's cash flow, that's not income, right? Because I'm getting some of my money back. All of a sudden, the tax proportion is only $15,000. And I put over here the word, really? You mean only $15,000 is even taxable? Yes, because it's my own money coming back. And because my money coming back, the total tax on this was less than $5,000. The total tax on $113,000 of cash flow. It gives me a lot of money with which I can buy life insurance. If I just bought a life insurance policy at age 1, on an 80-year-old at $1 million, it's basically $55,000. And I mean, different policy might be more or less, but that's in the range. It still had net annual income of $53,000 and change. That's after tax. More than he's getting on a CD, more than he's getting in close house. So, fashion, it's not tied to market performance. There's no income or state tax on air, on ILIT, on assets, and that can be true for quite a number of generations. No, the income tax ultimately when we get it, but not for the near term. And it ties guaranteed insurance policy with the guaranteed cash flow. And again, we have to have somebody for whom insurance works. I did have somebody for whom did something like this, and he actually was rated for his insurance policy, but he's also rated for his annuity. So he got a higher annuity payment to pay for the higher income tax payment. So here's the annuitize your cash example. Existing plan of death is $1 million of cash. If you lived in Maryland, D.C., the state estate taxes here, $840,000 beneficiaries. versus $1 million either way. An IRA retirement trust, this is a way to truly get a stretch. Everybody talks about stretch. How many stretches are actually going to happen? Very few. Very few. Divorces happen. Houses happen. Vacations happen. Lawsuits happen. Everything happens. Children's education happens. I mean, a lot of things happen that are good or for bad. People aren't going to do it. That's just the facts. I don't mean there isn't going to be anecdotally somebody that once did it, but I'm trying to tell you that it's just going to be rare. You want to guarantee this happening? The client I just had in the office, we were just creating today, this afternoon, an IRA retirement trust for her great nieces and nephews. Right? She was a single lady. Why would I give the money to my nieces and nephews? Why don't I give my great nieces and nephews? Because they're going to take my money and use it in part to pay for the education of their children. Well, their children have lower income tax rates. The children has a longer life expectancy. I can guarantee the stretch. I can do this with a special trust. It's also asset divorce protected for beneficiaries and an opportunity for significant income tax referral by potential. I just want to show you that there are strategies that you can actually put this in place with, an existing retirement trust and make the selections to do that, whether you want a conduit trust or accumulation trust. You can also use this, I have a variation on this where you put this as what I call a retirement education trust. That's actually what we did for this lady. If she is deciding or will decide to put money that their great nieces and nephews are quite small. I mean, one is like a month old and one's 3 or 4, ages 3 or 5. She can also decide to hold a 529 inside of this trust. And now I have all assets going to be asset protected. It's going to be enhanced by IRA protected proceeds of death. So all assets are income tax or tax deferred. But it guarantees the stretch. It guarantees the stretch. Or at least it gives a barrier to the point where at least someone has to be thoughtful about what's going to happen with the money coming in. Strategy drafted loan provisions to provide supplementary retirement benefits to grantor and spouse. So the person creates it for him or herself. If they marry, we can get at those assets through the spouse, or if it's a single person, I can get those assets by borrowing cash value with a trustee that would be amenable to that opportunity. And I can do this with a trust-owned, what I'll call low death benefit, high cash value policy, that I was saying that Gordon and I had talked about, where we have these strategies where the cash value is very high. It's not really so much for the insurance because that's not what the objective is, although it's there. It's now going to get this additional benefit of having this tax-free source of resources. So it maintains the estate tax included for definite, and you can have it both ways. A question was asked before about whether we use survivorship policy, or the previous slide, it showed how you use a single life policy. This is a place where you use a second to die policy as an alternate investment inside of an ILET. This would be a place, it seems to me, you're going to use the opposite strategy, where we're going to have, it's the opposite of the previous strategy. It's going to be for maximum insurance leverage. So I'm going to put in as low cost of premium as possible. Maybe I couple this with some kind of a term policy that's available, or at least I begin to leverage it to get a greater benefit. So I have a lower cash value, high death benefit policy, and again I'm now estate tax, income tax, and generation skipping tax, legacy tax free. Intergenerational income shift. This is kind of like a no-brainer. I mean, everybody's been doing this for years, except nobody's been doing it for years. It's talked about, but rarely executed in my experience. A lot of times families don't want to make their kids in an era. I mean, it's done for all the good reasons that you don't want to cause people to have excess resources, whatever. And of course, with trust and other strategies, you can do this where the parents can maintain more control than not. You can hire people. So you can create a family partnership with low or no discounts for family entity. Because again, we're not carrying that so much about estate taxes anymore. I want to have that asset protected. And I don't have to give them resources at the beginning. If I have 18-year-olds or 20-year-olds, or a little bit older, I can hire them. And I can pay them with their W-2 or 1099 income streams. And I can have that as an on-off switch. If they're not performing, or maybe earning more money, or I don't want to do it anymore, I just don't hire them right now. It's up to me. It's a business. All the reasons it's a business, right? I'm there. I can do this with securities. I can all securities partnership, and I can hire my child who's taken education, business management in college to assist with that. And of course, I can make gifts to children, and I can also do opportunity shifting. A lot of people are businesses; they're in seriatim producers of business. why don't I want to produce the third business in the name of my child? I mean, it has little or no value at that stage. And of course, for all those income tax reasons I talked about, all those AGI reasons I talked about, we want to make sure that we're now doing income tax is now a bigger thing than estate tax in most circumstances. So this is the place, and it also will free up annual exclusion gifts for other purposes, and also frees up lifetime exemption gifts on transfer. New rules. We have a television comic who's always talking about new rules. Here's the new rules right now. And this is what I was saying earlier, that all of the trusts that are out there that have already been created, all of the limited liability companies, family partnerships that have been designed over the years for getting discounts. All of a sudden, I don't care about discounts anymore if I think that the exemption is going to be there at $5.25 million and rising, or for a couple of $10.5 million and rising. I don't want to eliminate those discounts. I want to get them out. So what do? I have to redo them. I have to do them. The new battleground is income tax, not estate tax. We don't care about the estate tax anymore. I want to get step-up in basis. I want to be able to shift income. I want to be able to do the income shifting we talked about on the previous strategy. And I want to be able to do that in a fashion that I can get out income tax. And when there is a death, I'm going to get the highest value I could possibly get for that, because I don't care about discounts anymore. So I'm going to amend all previous discount clauses in my agreements to provide either a put right, a withdrawal right. There's other strategies we can do that. So all I need to do is say that any limited partner at any time will have a right, or certain notice provisions or what have you, to withdraw money or capital from the plan, or with a certain amount of notice, or with the permission of somebody. You can figure that out. And there are valuation appraisers out there that can help you with this, and they'd be pleased to do new evaluations for your partner, your clients, a partnership, or LLCs, and assist you. The trust I create for myself. Sometimes I'm called the settlor or grantor of a trust. The idea of a self-settled trust means it's an asset-protected trust where I can create one for myself. And I mentioned earlier that the great state of Virginia, the Commonwealth of Virginia, is part of the now 14 states that have now created the opportunity to have these kinds of trusts. In the past, it's always been considered against public policy. The great tradition of Anglo-American jurisprudence, I could never create a trust for myself which I could enjoy a benefit that I could prevent others from getting from me. Now, there were some exceptions to that. Some exceptions are retirement funds. Some exceptions to that are IRAs. There are exceptions to those and have been in there for a long period of time. Some states added insurance policies in there, as an example. Maryland has that exception. Virginia does not. But those concepts are ones that are now emboldened because I now have 14 states saying, no, it's okay. As long as you're not cheating somebody who's a prior creditor, or not cheating a family member for support, or for spousal support, or for child support, or other certain exception creditors, you can actually have the protection against someone suing you. So anybody that represents me as a director or officer of a large corporation, even a small corporation, this is a classic doctor, lawyer, Indian chief. Anybody who could be sued who has extra assets, what we call rainy day money, should avail themselves of this, it seems to me. And it can be made, again, what we call gift tax defective, especially where we don't have estate tax concern. So I can put money in such a trust, and it can be included in my estate, which automatically gives me that step-up in basis. That's one of the things we'll talk about here in a minute. Rather than me give it away, have it growing inside there, and then when I pass away, there's no step-up in basis. The classic logic was that I never used to be able to prevent people from estate tax return.
Right.
And when you file a state tax return, you file the same return with the state of Maryland. If they somehow object, it's either stepped up or it isn't. I believe you can buy the jurisdiction for Maryland and state purposes, and Virginia and D.C. as well. But I think that's neither here nor there. The point, here's the bottom line. You're into the world of nothing venture, nothing gain. If you end up where you would have been and not having done this, what else could have you done? And the answer is, this is a home run. That is, and I'll go through the strategy in more details in a moment.
Okay.
Yes, sir.
I have
Yes.
two comments on the self-settled trust. Does it make sense to have one for to hold an islet and the other one to hold the asset that you want to have appreciated at death?
I think it depends on what your objectives are. But I mean, in the ones that I have done, we've actually had the life new rule. We want to have income tax avoidance. I mentioned that this strategy is is perhaps the least well-known, least used of virtually any that is going to give your clients an incredible result. Incredible result. And the incredible result is, what is the normal result that one would have in a circumstance where the fair market value of an asset is, say, $3.5 million? Fair market value 3.5, and it's sold while both people are alive, a couple is alive, and they have a basis of $100,000. Right? The capital gain is $3.4 million, and that capital gains tax we mentioned before is 20%. Remember, this is AGI. You're going to be well into AGI with that kind of gain. Even if it's $350,000, right? You're going to be well into AGI if that's into this 23.8%. And I'm going to pay state estate tax here at 6%. It's just an arbitrary state. Your DC, nearly 10%. Maryland, nearly 10%. All of a sudden, I have a third of these assets going out, or 30% anyway, for a total capital gains tax of $1 million on that kind of transaction. And the consequence of that is nobody's going to sell it. Probably. May not. At least they have to think long and hard. We talked a moment ago about, maybe doing installment sales or doing other transactions to deal with this, but to delay that provision is a big thing. But what happens in states like California? What happens in states like Arizona, Texas, New Mexico, Washington, Idaho, Nevada? There are 10 states in the United States which represent roughly 30% of the U.S. population. That's a big swath of the U.S. population. Where if one of a couple passes away, they have a special set of rules. But here, large in the East Coast, the other 40 states, or 41 counting the District of Columbia, we all of a sudden have, if one spouse passes away and then the property is sold, I have a fair market value for the, I'm going to go back to one slide, this is the basis, here is only $100,000. So if I go here, a surviving spouse, if they own the property 50-50, the surviving spouse still has a basis of half the initial basis, that's $50,000. And even though I get a step up or adjusted basis for capital gains purposes on the deceased spouse's half, on the survivor's half, the total tax is half of the tax on the previous slide. So on the previous slide, I had tax of $1,020,000. If one person died and then the property was sold, the tax would be $510,000. And oh, by the way, if the one that didn't own the property, let's say it was Jack's property and Janice passed away, there's no step at all. But in those 10 states, those community property states in the United States that have those rules, if one of the two pass away, no matter how the property is titled, no matter how it's titled, if it's in Jack's name and Janice passes away, or in Janice's name and Jack passes away, or at 50-50, it doesn't matter, there's a complete step up in basis. Code section 1014B6 tells me if I'm in one of those states that has those rules, I get to have community property at 3.5. The deceased spouse's step up is 0. The surviving spouse gets 3.5, and there's 0 tax. 0. Community property trust is a revocable trust, changeable, amendable. We do joint trust in our office about 80% of the time. A community property trust is a joint trust between a husband and a wife.
Right.
It has
I'm
certain
not
assets.
concerned about community property trust.
So that's a different one. Now, in a self-settled trust, all it's saying is there are 14 states that have said if you only have one of these trusts, then your assets are protected. Virginia has just joined that crowd. Right? There have been a couple cases where that has been upset for reasons, but usually it has to do with fraud, with deceit. It has to do with the classic hinder, delay, or defraud creditors. There have been a couple cases like that, but you have, again, tens of thousands of these trusts in place. I mean, again, you're into the world of nothing venture, nothing gain. I wouldn't rely on them exclusively. If I was going to be concerned about it, I would put my securities, by example, into a LLC, and I'd put my LLC interest into a asset protected trust. The idea is to have rainy day money for me. That's what this is. And again, if it's set aside, I've tried and nothing worked, but at least I tried. The thing is that the cases where the ones you're not hearing about is the ones where it has worked, right? Because the earliest of those trusts have gone back 15 years at this stage. It's not exactly like this is a new thing. It's gone on and on and on, and more states are adopting it, including Virginia. So I'm not disagreeing with you. I'm just simply saying that there's no downside to do it. If someone's sued and loses and doesn't have one, they're going to be looking for why didn't you tell me about it.
We're beyond our time
All right.
now, so if anybody has, they need to leave, then they're certainly welcome to. People seem to be following this and being interested in it.
If we have to
give
leave,
Bill-
can we get a copy of the presentation?
Yeah, we can get it. Yeah,
With
if you
the,
want to, we can send a copy of the
the
presentation to everybody.
The audio.
Oh.
Let me
Yeah, and that's possible too.
let me conclude on this. I'm going to conclude this with a quick summary, and then we can get into the cookbook and you choose.
Okay, the one thing that I promised people that you would cover is how do you get a step? You have a typical Fred Children's Trust family and Merrill Trust. How do you get a step up in basis on the second step, 100%?
We'll do that. Let me just
How much longer are we got? Because I asked them to do like a 4-hour presentation, an hour and a half. So
20 minutes.
20 minutes. Okay.
Look, I just want to. This is a question right now. You've got, the question was earlier about what does a client do, what does a person do who's had a plan for a long time? And I'm simply saying every single plan has to review. Not some of them, not a few of them, not most of them, everyone. Because they all have things in it that have to do with state taxes that still may be relevant, but now we've got also big income tax considerations. This is one that maybe you haven't thought about. All of a sudden, digital assets are big, and the last thing I heard before I walked in the door here was how Facebook now has put, with their Instagram subsidiary, has now put moving pictures on the Instagram thing, and all of a sudden we're saying that's a new breakthrough in mobile technology. I mean, the point is so many people are keeping things in digital assets, and you don't have a way to get at your clients, or your clients do not have a way to get at their own digital assets. Unless you've got it in the plan. At least there's something written about it, right? These general clauses, and my agent could do everything and anything. I mean, let's put something that's specific, right? So how does the holder of powers of attorney or successor trustee get passwords, or media accounts, or photo accounts? And the answer is to restate all trusts and to redo new powers of attorney. Here's an example of digital assets. When trustee authority access, modify, control, archive, transfer, delete digital assets include set receipts, emails accounts, digital music, listserv, service blogs, files, etc., etc., etc. Right? Digital assets are stored in cloud and all digital devices. They delete, they use peripherals. I mean, it's just to give people a power. So at least you have the argument, right? Which heretofore, the people getting pushback. And here's an example. Again, this is the well-counsel system. We now have a choice in to manage digital assets, so we can do the power to sell, buy, part of contract, manage real property, and manage digital assets. And then this is a similar clause within a power of attorney to do with that. It just as a restatement, go forward and talk to all your clients. You should be telling your clients about that. Richard, you too. We talked about annuitizing IRAs. We talked about using standalone retirement trusts. We talked about using life insurance to access retirement life insurance trust to be able to get access to high cash value life insurance. We talked about guaranteed survivor policies with an ILA as a legacy gift. These are people who want to give assets away, that obviously survivorship policy is for somebody else. We talked about self-settled asset protection trusts. We've also talked about, this is the repeat, we talked about asset protection trusts, Virginia being one of the states that now has it. Income shifting within family entities, big issue, right? Reducing or eliminating discounts. You've got to do that. Anything you spend all this time talking to people about all the discounts they're going to get, if they now have assets under these thresholds, you should go back and revisit them. We talked about community property trusts cited under Alaska law, and we talked about making restatements of plans for digital assets. I've got 2 other ideas for you. For senior asset protection trust, maintenance programs for clients, life insurance audits, especially typically owned inside of the island. You've got to go back and do these things. And now I think a bigger area is now looking at Social Security analysis and payout strategies. I read that like 10,000 people turning 62 every day. So all those people becoming Social Security eligible, should they keep it, elect, freeze, status, does the spouse begin payments, all those kind of things. Right? So those let me go back one. I'm sorry. Let me go back to this chapter. All right. Let me go back to.
else has another statement?